At the end of this year, how do you want to summarize the US economy this year?
I think it's been a very challenging year. Obviously, inflation has been very, very elevated, the sort of inflation that we've not seen in 40 years. And then, of course, as a result of that, the Fed has hiked at a pretty historic pace as well. They've raised rates by 425 basis points this year. So the combined effect of that obviously is having a pretty significant effect on the economy. The housing market has gone into recession. And if you look at underlying overall demand, that's also quite weak. It's still positive, so we're not yet in a recession, but it is quite soft. On the flip side, though, the labor market remains very hot. Job growth this year is estimated around 4 million, which is very, very strong, much higher than what we need to keep up with population growth. And as a result of that, wage inflation has also been quite strong. And all of this has meant that the consumer has remained relatively resilient. There are some signs of slowing in consumer spending, but overall, just a very resilient consumer, also benefiting from excess savings from all of the fiscal stimulus that was distributed during the pandemic.
So you expected a mild recession next year. What will it look like?
Our base case is still for a relatively mild recession. We have a 1% decline in GDP from the peak to the trough. And by historical standards, that's still relatively mild. We have the unemployment rate going up a little bit above 5% by the end of next year. Again, by historical standards, that's not a very high unemployment rate.
You also projected the headline CPI will fall to 3.2% at the end of next year, but you also mentioned that more needs to be done before the inflation is controlled. What do you mean by that?
So what we mean is that the Fed probably has more work to do, which is why we expect them to hike another 75 basis points at least. Again, risks are that they do even more than that. But it is important to mention that our forecast is premised on a significant drop in goods inflation and potentially outright goods deflation. So it's not just that demand slows and the labor market weakens. That's obviously a big part of it. But we also have in our forecasts that goods prices start to move a little bit back towards the pre-pandemic trend because supply issues are getting sorted out. And that helps quite a lot to bring inflation back down to 3%.